Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is the earnings special edition where our focus is on the earnings of Mphasis. Now, we do know that as far as the earnings go for the company, this is an IT company. On the net profit basis, as far as the consolidated numbers go, there was a dip of 2.9% at 393 odd crore rupees in the March quarter, as the company had posted a 405 crore rupees of a net profit in the same period the previous year as well. Now, when we talk about the consolidated revenue from operations, they've increased marginally to 3,142 crores as far as the fourth quarter goes. This is as compared to 3,361 crores a year ago as well. To discuss and to decode for us what are some of the other key fine print as far as the earnings go and what's the outlook going forward, I'm now joined by the top management of the company. Mr. Nitin Rakesh now joins in. He's the CEO of Mphasis. Warm welcome to you, sir, to Business Today Television, and thank you so much for taking the time out for this discussion. First up, if you could tell us, broadly speaking, has the quarter gone by really met your expectations, or you think you could have done better in some of the metrics, maybe margins or profits? Do tell us what was the contributing factor here.
Sure. Firstly, Sakshi, thanks for having me. I think the year that just went by, FY24, obviously was a fairly headwindy year from a macro perspective, not just for us, but pretty much for the entire industry. We are fairly pleased with the way revenue has recovered in the last two quarters on a sequential basis. In Q4, we delivered a 2+% sequential growth led by TMT and banking. As such, I think very pleased with the fact that we were able to finish the year on an uptrend. And that also sets us up, rather well for FY25 that started April 1. On the margin front, I think the operating margin at a adjusted level is actually higher than previous year. We had an acquisition impact that came into the last 2 quarters of financial year. A lot of it is goodwill amortization, non-cash charges. So I think we're fairly pleased with the fact that on an adjusted basis, we ended up at the upper end of our guided band. That was around 15.5 to 16 to 16. On an EBITDA basis, we've actually expanded the margin in the same period by 70 basis points because many of those charges were non-cash, as I mentioned. So I think fairly well placed from a profitability standpoint. It's been very, very steady for us over the last almost 12 quarters. We've actually been in that band that we've identified for ourselves, so we can continue to make investments around it. And as I mentioned, right, a lot of the metrics, especially around Q4 growth, sequential growth, were pretty strong. So very pleased with the way the year ended.
Okay, pleased with the way the year has ended. How about the overall demand environment now that we step into the new fiscal year, sir, that you see as compared to the previous few quarters? Are you already seeing some green shoots emerge? And what's the outlook for the entire fiscal year, the way demand scenario will pan out, sir?
So I think the environment is still pretty uncertain, given the interplay between macro, interest rates, inflation, geopolitics, elections, not just in the US, but pretty much globally. So it's very, very hard to call a bottom to macro. But what we've definitely seen in the last few months is, I think, the change fatigue of having overspent in transformation programs in 21 and 22. At least that seems to be a little bit behind us from a client spend perspective. Also, we are seeing new pockets of spend open up around things like implementing a Gen AI platform or a solution. However, the overall budgets are still fairly cautious. And I think the interplay between identifying areas where you can squeeze run costs or optimize, do a cost takeout program, and then use that money to redeploy in a transformation program around accelerating the cloud journey, or more importantly, using an AI platform to squeeze costs. Those are definitely new areas of opportunity that have shown up. Hence, if you look at the pipeline, it's actually still fairly strong, up 5% sequentially. The segments of market, especially around BFS or macro-related segments, are still, I wouldn't say, reversing from a trend standpoint. But we've seen some early signs, especially in BFS, et cetera, in the US, where some discretionary spend seems to have come back as the capital markets have started to reopen with a bunch of deals around IPOs. So again, very early to call. The only metric I'll point that to is the less than $10 million deals have seen a pretty good uptake in the last quarter, which typically is a sign that short burst, quick consumption programs are now starting to get funded. Now, whether it's a one-quarter phenomena in the beginning of the year or it's something that will sustain, we'll have to wait and watch. But I think compared to FY24, given that at the start of the year we had a pretty severe regional banking crisis that seems to have been under control, despite one other bank, being in the news over this weekend, but a relatively small bank. So I think if none of that bubbles up again, definitely, FY25 will have some shades of being better than FY24.
Okay, understood. Now let's come to the specifics, both on the margin and then I will understand from you on the top line guidance as well. How does the picture really look like as we pan out to the entire fiscal year? What levers would you have to improve margins from here on? And if you could mention any current pulls and pushes that you are facing?
So I think from a margin standpoint, we've guided 14.6 to 16 as a broader range. Now, this is obviously post the M&A impact. There's about a 1% impact of M&A in the numbers. We do expect that by the end of the year, we should have, come out of that impact and potentially, as we go through the year, we will see hopefully a slightly better picture in terms of, quarter-over-quarter improvement in the EBIT profile. As I mentioned, EBITDA is fairly strong, and I think we are 18.7 as of Q4. So we'll definitely see a little bit of uptick there as well. I think the levers are pretty straightforward, right? Firstly, can we, continue to find ways to, use all the levers around, higher offshore utilization, in general, higher utilization, using tech to deliver some solutions. There have been a fairly good indications that we now have the ability to deliver solutions using not just people, but a combination of tech and people. So there's some increasing confidence that we can bring a little bit of non-linearity and operating leverage in the business. Fixed price optimization definitely is a good area because we have almost a third of the business that is based on outcomes. So I think fairly confident and comfortable that the margin band that we've talked about should be very easily achievable. Of course, there is work to be done to make sure that every lever is pulled. But more importantly, I think we are focused on driving at least on a sequential basis revenue growth, because that in itself gives you a little bit more operating leverage.
Right. As far as the current quarter goes, that's the April to June quarter. Do you also roll out your wage hikes in this quarter? And if at all, then what could be the impact on the margins for this current quarter? And even though that you've guided 14.6 to 16%, and you're more than hopeful that you'll be able to achieve that, will that be a quarter that one needs to watch out?
Yeah, I think we've taken a slightly different approach over the last few years, where instead of rolling out wage hikes in one particular quarter, it's pretty evenly spread out, and it's linked much more to a talent reskilling program that we run internally. So as folks continue to upskill themselves, they actually gather tokens and points and coins, and that goes into our entire increment policy. So it's not one single quarter where we will have a big impact, and hence our ability to guide towards that band and stay within the band for the full year is pretty high.
Fair enough. On the hiring trend, sir, could you give us a clear picture as to how are things progressing? Why I ask you this is because in the Q4 quarter that we are talking about right now, the larger peers, the large cap IT firms, they've actually largely talked about or displayed some kind of an employee headcount, which has seen a reduction, and the hiring trends also look subdued than the previous year. They are going to be probably hiring lesser freshers than last year. What is the trend at your end? I want to understand, because you will be able to give us a better picture of how mid-cap IT firms are really looking at this factor.
Yeah, I think from a hiring standpoint, there are two things at play. One, almost everyone's focused on optimizing their own P&Ls because demand environment is uncertain. So instead of taking a longer term view and saying over the next 12, 18 months, we will need to build bench, we are going to, go and hire X number of people. I think everyone's really focused on optimizing utilization to some extent. So whatever, bench and buffer is currently available, can we first utilize that and then take a little bit more shorter term view to what hiring needs we will have. And not very different for us. Again, I talked about fixed price optimization, high realizations. I think all of those are focus areas that are not dependent on additional people or additional hiring needs. Will the industry actually hire people? Absolutely. There is also some early signs that we have the ability, as I mentioned, to deploy tech solutions in addition to just people. But again, it's a very early, phase in the whole adoption of AI and Gen AI platforms. So I think we'll have to wait and watch and see how that goes. So I think there is definitely a little bit of a hiring lull, so to speak, but that's more a reflection of the demand environment and the fact that everyone wants to optimize their own internal utilizations. As far as we are concerned, we are taking a very dynamic approach to headcount addition. We're doing a rolling 90-day, a demand scenario. And based on that, we'll continue to forecast what we need and how we can add. We will definitely add freshers this year as well. We've been doing that even through FY23 and 24. But I think the number of hires, what kind of talent you need, what kind of reskilling program you run is all dependent on what the demand environment looks like, and especially in those skills. Just like 10 years ago, Sakshi, we went through a pretty big phase of talent reskilling across the industry, right? We went from waterfall to agile, full stack developers, cloud and data. I think we're going to go through a pretty similar phase. We already are going through a pretty similar phase because now you not only need people who know, how to code on an AWS native or a Microsoft native or a Google native platform. You now also need people who actually can adopt the code acceleration that comes with a Copilot or a code whisperer or a Gemini assist. So I think a little bit of a different paradigm, as I mentioned, still very early in that cycle, but definitely that will have an impact on not just hiring trends, but the type of talent you need as well.
Okay. A little bit on the deal pipeline, sir. This quarter, you've reported slightly softer deal wins. Was it a one-off? And going forward, how does the pipeline really look like, especially for some of the key sectors that you've been mentioning? You're looking at some green shoots emerging, especially, and also some Gen AI highlights that you can give us.
Sure. So I think firstly, for the full year, our deal wins were about 5% higher than last year. We had a pretty big, first half of the year where we sold $1 billion of deals in just the H1 segment. What that means is that, you then take time to rebuild the pipeline and run it through phases. And that's what's been going on for the last couple of quarters. Pipeline on a quarter-over-quarter basis is still up 5%, which means we have deals in the pipe, many of them large. So as such, I don't think there's anything to call out for in terms of the trends. I think by definition, TCV closures will be lumpy, especially around large deals.
Okay.
Two other nuances to the pipeline. I think one I mentioned already, right? The less than $10 million deals are picking up or have picked up in the last quarter. That means that your pipeline is actually to be consumed in a shorter duration, right? So sometimes you'll get a 6-month, 9-month, $5 million program that has to be consumed within that period. So that the correlation to revenue growth actually gets better with these shorter term deals versus a 3-5-year deal that takes 2 quarters, 3 quarters to ramp up. Secondly, we still have deals from the earlier part of the year that are not fully consumed and ramped up yet. Right? So that definitely bodes well for short-term revenue visibility. In terms of Gen AI, I think we went in 23 was all about understanding from an enterprise standpoint. If you look at our clients, they were evaluating it. They were trying to understand how they should structure themselves, where are the applications going to come from, what should be the platform choices. I mean, remember, there is a lot of noise out there as well in terms of, just on Hugging Face, there are like 50,000 LLMs available, right? So how do you curate those? Which ones to apply, which use cases to do, which business case supports it? We are now starting to see at least early adoption in a few very clear areas, right? Customer experience transformation, operations of both technology and business, developer productivity. These are early signs, early programs that are now starting to go into production. LLM management, LLM training. So I think there is at least from 23, where it was all about discovery, 24 seems to be about early implementations and early use cases. 30% of our deals were AI-led last year. And they're not like AI influenced, but they're AI-led, which means they actually have a pretty healthy component of the solution itself is an AI-led solution. Not all Gen AI, but a fair amount of conversational AI, a fair amount of machine learning assisted solution there as well. So I think if this trend continues, one, it'll be probably faster than what we saw on the digital side. If that took 5 years to come to fruition and cloud became mainstream, 10 years after it was launched, I think this will probably become mainstream a lot sooner because it also helps clients with taking cost out and redeploying that cost back into change programs. So I think very early days, but very good potential of uptake. Almost everything every enterprise does will get touched by some form of AI. Just like 25 years ago, almost every enterprise got touched by the last general purpose technology called the internet. So it's a very similar environment, but probably be faster than that.
Okay, understood. On the acquisition front, sir, if you could give us more details on Silverline acquisition and if there are any other acquisitions also planned for FY25.
Yeah, I think Silverline closed about 5-6 months ago. We've integrated the GTM. I think all the other system integrations are all underway. We should be done by the end of June. From an integration standpoint. At this point, the focus is more around GTM acceleration. This is a capability that we thought was important for us to acquire, given that the Salesforce ecosystem is a pretty important one when it comes to customer experience transformation. And of course, the big investments that they've made in areas like Einstein and Data Cloud. I think there is a pretty healthy pipeline. We've had a pretty good initial success. Acquisitions, anyways, as you know, can be tricky from an integration standpoint. But having said that, I think this opens up a whole new channel for us through the partnership with Salesforce. And at the same time, we are embedding that into a number of solutions that we're taking to customers as well around customer experience transformation. So still early signs from a uptick of synergy, but pipeline's pretty good.
Okay, got that. And last question would be on FY25 guidance as far as constant currency revenue growth goes. And are we going to see a better FY25 than FY24?
That's what we've called for, that FY25 will be better than 24. Given just the level of uncertainty, we basically said on a relative basis, we should be able to grow better than the overall India IT pack. And whether that growth for the industry is in the current range of guidance or that gets upgraded or downgraded, we don't know. But at least on a relative basis, we should see better growth than the industry average. And obviously, that will mean that even compared to our own FY24, we'll have a better year than 24.
All right. Well, all the very best to you, sir. And thank you so much for speaking to us on Business Today and helping us understand the insights from the quarter. And like I said, all the very best for the upcoming quarters. Here's hoping that we can catch up very soon again to understand the industry trends as well as the company's vision.
Thank you so much and look forward to talking to you again.
Thank you so much, sir. Have a great day. And with that, viewers, we wrap up this very special edition and the conversation with Mphasis top management. Stay tuned on to Business Today TV as we continue to get you more earnings insights from Q4.